Meb, I wonder, just talking about some of the oversold conditions, certainly the 10-day AD line. You think we're ripe for a bounce, and how long lasting might that be?
I would love to come on this show one day in the future and say I'm a romping, stomping bull. Unfortunately, that day is not yet today. If you look at our models, the ones that can be tactical in the U.S. stock market, they're as bearish as they can be. The two main pillars we look at, value on one side, stocks are still expensive. They're not as crazy as they were in January, but they're still on the expensive side, particularly if inflation sticks around, and we can come back to that. But then also on the trend side, U.S. markets and almost every market in the world, honestly, is in a downtrend now. You put those two things together, you get a lot of volatility when the market is in a downtrend. So the vast majority of the big up and down days occur when the market is already in an established downtrend. And if you miss both of those, we published some research on this years ago, you actually end up in a much better place, avoiding the 10 best and worst days, because they tend to cluster together, these like volatility gremlins. So usually it's better to sit out and wait for a better time.
So if the multiple's gotten crushed because the market came to Jesus on rates, do you think they're going to come to Jesus on earnings once Q3 starts to print?
The thing about when you mention the rates and its close cousin inflation, we did a tweet the beginning of the year that was very unpopular. We talked about it, said, look, historically speaking, when inflation's this high, these long-term PE ratios, they're down about half of from where we were at the beginning of the year, or excuse me, about half from where we are today. And much further from the beginning of the year. So yes, we've fallen 20%. This is a top 3 worst year ever for 60-40 if we close today in the last 100 years. The other two were in the Great Depression. It doesn't feel like a warm, fuzzy place, right? The average allocation portfolio is probably down 20%. But the thing is, it can get worse. That's the thing that 60-40 global allocation investors don't understand. It can get a lot worse. And so the problem is, if inflation sticks around, even if it goes back down to 6, 5, 4, the average multiple is low teens. And if we're in the mid to high 20s right now, you can see how there's a long way to go.
Meb, I want to go back to what you said about stocks being expensive. Stocks are expensive, assuming what about 2023 revenue and earnings and beyond?
Market cap weighted. And so you're right. When you say stocks, it doesn't mean everything. I can say I'm a romping, stomping bull on value stocks. A lot of the quants, the nerds like me, come out and say, look, there's this historic spread between the cheap stuff and the expensive. It's at levels not just in the U.S., but around the world, close to we've never seen before, which is great. Anytime you get in that like top 10, top 5 percentile, it's usually a good time. Doesn't mean it can't get worse, but usually a good time. Particularly if inflation sticks around or is stickier. Some of the best investments during the 1970s, during the 1940s, places you could hide out were value stocks. If you look abroad, by the way, some of these foreign developed and emerging market countries have about a 7% dividend yield plus on some of these now, so we're looking extremely attractive.